Okay, Sid, if you could give me the next. Okay, this is the eye test. Sid, you asked what happens when you download it. This is what happens when you
I got
download
it.
it. Okay. So there's only one thing wrong with this from a easy work standpoint, from my standpoint anyway. The good news is score and safety are right here on the left-hand side. You can see them both. Those are both very important. But for what I was trying to do, I also wanted to get the Sharpe ratio. That's way, way, way over here on the right side of the spreadsheet. And I also wanted to be looking at the 10-year returns for the strategy. So if you go to the next slide for me, Sid. So this is what it looks like reorganized, Gary. It just takes a couple of minutes. All you have to do is move the columns together. So here I've got them lined up the way I wanted to look at them. Score, safety, Sharpe ratio, and 10-year returns. And in this case, it's sorted by Sharpe ratio. So the highest Sharpe ratio is at the top. And moving on down. It's a good, quick way of trying to be able to pick out candidate strategies for what you're trying to do. Way off to the right, not seen in this spreadsheet or even in the previous one, each one of these strategies have displayed all of the constituent mutual funds or ETFs or stocks that exist in that strategy. Usually 12, but sometimes less. And it's pretty easy once you've gone through the initial selection of candidate strategies to go over there and say, okay, how many clones do I have? It's a little tedious because you have to go through and check what mutual funds or what ETFs are in each strategy, but it's worth your while doing that. Okay, next slide, please. So then comes the hard work. Going through and tweaking all of the knobs in the advanced option feature. You get the advanced option feature by clicking on the little blue circle with an eye that you see by each strategy or by each portfolio. When you click on that, you will get the advanced option screen that looks like this. And there's an excellent help file in Adobe PDF form. You just click on this blue button, it'll call up about a 8-page document that gives you a nice explanation of what each one of these functions does and how to manipulate it. When I started this, I realized there were going to be a lot of variations for each strategy before it got optimized. And I just threw the different things that you could change into a permutation and combination calculation. And it came out to be something like 460 combinations per strategy, right? Well, in reality, it's not that bad because there are some of these that you don't really change very much. If you've got a stock or a ETF strategy or a mutual fund strategy that's based on stocks rather than bonds, then you're going to click the S&P 500. You're not going to try the bond button. You might try the automatic, but by and large, if it's a stock or an ETF representing stocks, you'd click this. On the other hand, if it was an income-oriented strategy based on bonds, you would probably click on the aggregate bond button. Or you can take the easy way out and go automatic and let the sector surfer system pick that out for you. As you look at this chart, the top one just tells you the strategy name. The minimum hold time is, in this case, trade automatic. The trade automatic is a very, very handy feature if you have mutual funds in the strategy, because what it will do is take into account automatically the holding period for each mutual fund, and it won't trade you out of that mutual fund while the holding period is still in effect. And it does all of that for you automatically, which is really a nice feature. Under trade automatic, you have other options. You can trade daily, you can trade every weekend, you can trade at the end of the month, you can trade every 30 days, 60 days, 90 days, etc. It's your choice. Trade automatic is a relatively easy way to go, but you may have a feeling that you want to rotate things quarterly rather than every month. You can do that. You can select that here if you wish. The next line down tells you the identity of the particular strategy that we're looking at. And so if you want to import that into your portfolio, you just copy that, paste it in, and boom, it'll come into your list of strategies. And you have a place to put notes in there if you want. I had notes on all of mine, but this one's blank. When you go down into the advanced option section here, this first one does not really change anything in the results. This just has to do with appearance. The flex chart start in terms of years tells you which chart is going to come up first. If you have 3 in there, the 3-year chart will come up first. Less spaghetti means that you don't look at all of the constituents of the strategy. Painted path is a nice option. It will let you see which component of the strategy was driving the results at any particular point in time. And it's color-coded so you can relate it back to whatever ETF or whatever stock or mutual fund you have. But having said that, that's not going to change any of the results. These are the ones that change the results. Storm Guard options, standard Storm Guard, disable. You might want to disable it if you have a inverse component in one of your strategies, or if you have bonds, for example. And then there is Storm Guard Adaptive Quick Response, AQR. This responds more quickly than the standard Storm Guard, and for many strategies works out a little better than the standard Storm Guard. The reference index we talked about earlier, you can go automatic, or if you know it's a stock-heavy strategy, then you can use the S&P 500. If it's a bond, you can use the aggregate bond. The most important one here, to me anyway, is to click the forward walk progressive tuning. That turns on this powerful feature that gives you a much better glimpse of reality than pure backtesting. And the other really important one is the born-on date. The earlier you can get the born-on date, the more forward walk testing you're going to have, and probably the more realistic and more valid data you'll end up with. These other ones vary. Stronger filtering, sometimes that works better, sometimes it doesn't. When you engage stronger filtering, it runs through the filter twice, rather than just once. Bias toward short trends. Once again, sometimes this works better in a short-term trend, sometimes it works better in a long-term trend. In this particular strategy, long-term works better than short-term, so that's unchecked. The last one here is decision shift days. You can shift the actual execution time plus or minus, I think it's 11 days from the nominal time that's delivered by the trading on the trade period you pick up here. So you can make it happen 1 day, 2 day, up to 11 days earlier, or 1 day, 2 day, up to 11 days later at that time.
Hey, Brett,
Yeah.
do you know if when you shift the decision days, if it makes believe that it's that date and it's doing the trading, or does it, I can phrase the question right. So let's say I'm 3 days before the end of the month, and I put -3 in there. Will it make believe now it's the end of the month and then calculate it as if it's the end of the month?
Yeah, it offsets the decision time by the number of days you put in there here. So if you had the end of the month down, and you had a -3 in there, it would offset it 3 days before the end of the month.
So it does all the back calculations in that also?
Based on 3 days ahead.
You're not picking up much.
And,
That's my understanding.
so you had also on the forward walk progressive tuning, so you set it back a couple of years and your strategy does worse. This probably means you don't want that strategy.
No, it doesn't necessarily mean that. Other people probably have more experience at this than I do, but what I found in my experience is that when you implement forward walk progressive tuning, oftentimes the results, the returns, don't change dramatically. Sometimes they are a little lower, occasionally they might be a little higher. But what does seem to change are the risk factors. Drawdown goes up, Sharpe ratio goes down, the risk factors show up. And that's because you're no longer looking in the rearview mirror, you're looking through the windshield.
On the
Yes.
forward walk, I guess it's plus or minus 15. If you went plus 15, it stayed the same, or minus 15 stayed the same, and then on neutral it was the same.
I'm sorry, you're talking about decision shift days?
Yeah, I just shifted back and forth, plus or minus a month. If that came out neutral with no change, then really it wouldn't matter, would it? Or-
Yeah, there's, if you go to the PDF file here, there's a very nice write-up on that topic. And what Scott does is to show you the curves on a particular strategy of how it operates relative to shifting the decision days. The particular example he's got in there, I think, has a peak just before the end of the month, also has a peak just after the end of the month. But it's a very good write-up on it, it'll help you on that. You can't, incidentally, I don't think you can offset at 15 days, I think the max is 11.
Yeah, I don't really remember, but I know it's two extremes.
That's right. Okay, if you can show me the next one, Sid. Now this is largely swiped from Al. In his presentation, he showed a very handy spreadsheet for keeping track of all of this. This is very abbreviated compared to the spreadsheet that I actually have, because that is just so full of numbers it would blow you away. I mentioned that there were theoretically something like 460 combinations, which means you could have theoretically 460 lines here. Now in practice that's not true, because in this case it's a ETF portfolio based on stocks, and so S&P 500 is going to stay constant, right? The born-on date I pushed back as far as I could relative to the ETFs involved, and so this one, you notice this started out being June 6th of 2013, just last summer. By pushing it back to the beginning of 2004, we have a much longer FWPT tuning period, and hopefully more valid and realistic results. So what this is just the key factors that we tweak, the knobs, as Al put it. Storm guard quick response, forward walk progressive tuning, short term, strong filtering, decision shift days, born on, and then the results, okay? So the top line is the standard version, which had no forward walk testing on it. The next line down, what we did was to move the born on date back as far as we could and trigger forward walk progressive tuning. The other thing was to, well, we kept the quick response storm guard. I tried strong short-term time constant, no filtering, no strong filtering, no shift. And the results on this, you can see, are not dramatically different in terms of returns, but the safety goes from 186 down to 155, Sharpe ratio goes from 157 down to 148. And I think if you look at the actual realized drawdown of that, you find it was quite a bit higher than the original. So, nice try, but no cigar on that one. The next one, changes here were to switch from short term to long term, and that made quite a difference. Returns got a little better. Sharpe ratio stayed about the same. Safety improved from 155 to 172. And then he went on and tried a few other things, a lot of other things, but I'm just showing you a few of them here. The changes here were to add strong filtering. That was a bit of a disaster. Safety score went from 172 down to under 50. Sharpe ratio went from 148 down to 129. So that was a non-starter. Similarly, in this last one, it went back to standard storm guard as opposed to the quick response storm guard. Used short term and no strong filter. And once again, results were not good. Turned out the best of these, and there were a bunch of other ones here that I'm not bothering to bore you with. The best one was this one right here. that basically had a long-term time period rather than short-term. It's a bit of a surprise because oftentimes short-term works better. But that delivered the best results for this. So you have to take this, imagine that there's a lot more on the spreadsheet, then multiply it by about 15 for all the other strategies you're looking at. There's a fair amount of work that goes into this, is the point. So if you give me the next one. So going forward, what about future plans? Well, one of the things that I'm considering is, do I re-optimize the portfolio periodically? Annually, maybe every other year, or maybe some other time period. There are new strategies coming up all the time that offer great performance. Might be better substitutes for some of the ones we've already got. The other thing is to work on a higher performance portfolio with larger number of strategies, accepting the fact that this might entail a little higher risk. So if you go to the next one, see. So this is what I'm working on right now. It's an alt ETF portfolio. This is up to 10 ETFs and some 2 times leveraged ETFs. No 3x leveraged ETFs. So far, it's showing some promise. It's delivering returns that are in the 50% range. Last 10 years have been about 50. Last 5 years have been almost 61%. Last year it did 69%. Real drawdown is about 13.7. That's the downside of this. It's not as low as I would like to have it. It's not under 10%. But this I like. 0.03% year-over-year probability of 15% loss. That's even better than the winning portfolio that we just looked at. That compares very favorably to 30.5 for the S&P. And the Sortino ratio is about 12.5 versus about 1.5 for the S&P. So this one shows promise, but what I'm working on now is how to get this number down. And I'll continue to crank up.
There are no inverses in this?
There are no inverses in this, and perhaps there should be. You know, maybe stick a PSQ in there and get a few inverse ETFs or funds in there. Yeah, good point.
What type of ETFs are these?
First of all, they all have high volume, so they've got fairly tight bid-ask spreads. I used Scott Judd's recommended figure of merit of using a $20 million trading volume on each one of these. Where we are right now, it actually has, this has 7 strategies in it. And 4 of them are not leveraged, 3 of them are leveraged. The leveraged ones are some of the ones that Scott's used in his strategy of strategies, his samurai portfolio.
So is this just one portfolio? It's not a strategy of strategy?
Yeah, that's right. It is not a strategy of
Do you
strategies.
plan to post this on the Hall of Fame? when you do?
Well, it's up to Scott whether these things get posted on the Hall of Fame, right?
Okay.
But this is still, I think, a work in progress. Until I can get that real drawdown under 10%, I'm not going to be entirely happy. I do like the returns. The returns are a whole lot better.
Returns are super.
Yeah, the returns are a whole lot better. And they're not really bad, and even this year it's been good. It's been almost 8% compared to 0.1% for the S&P. One of the reasons I did this is because I wanted something that would perform well when the S&P was performing well. And one of the characteristics of the Full Sail Express is that when the S&P is really booming, it's kind of mediocre.
So you could add that to that portfolio?
Yeah, I could. I could do a strategy of strategies, that's right.
Is there any longevity requirement screen for the ETFs that you're considering for this?
Oh, yeah. Yeah, I try to get ones that have been around as long as possible, so we can get the born-on date as early as possible.
So as long as possible means what?
Well, if you're talking about the 2x leveraged ETFs, you're really limited, because a lot of those came into being in the mid-2000s, so 2004, 5, 6, 7, 8 even. Some of them just have not been around very long. One of my favorites that I've been invested in for a long time is the BID, BID, which is the NASDAQ Biotech ETF. And it consists of all 126 biotech firms that are in the NASDAQ Biotech Index. It's a great performer, but it's only been around since the fall of 2006. And so there's not a lot of data. So when you come to the 2X leverage ETF strategies, you're limited in how much forward walk testing you can do simply because they're young, they haven't been around. The other ETFs, a lot of them, if you're looking at the sector ETFs, they've been around since late 80s, early 90s. So they have good longevity. Some of the country ETFs some of them have pretty long longevity as well. So it really depends, it's a mixed bag. It depends on which ETFs you're really looking at.
So these 10 include countries and sectors?
Yes, it does. It does. One of them is country ETF. These are the non-leveraged ones. One is a country ETF. One is a sector ETF. One is an asset class ETF. The leverage ones.
How did you pick which country to watch?
Well, that's a good question. Sid and I were talking about this earlier with Gary, and one of the mistakes that I've made is to look at Sector Surfer and say, nah, I'm going to get out of that. Sector Surfer had as one of its prime country picks for quite a while, EWP, which is Spain. I looked at that and I thought, I don't know about that one. Then I looked at the chart, and the chart dipped a little bit, and I got out, and of course it went right back up and performed very well. So think twice before you second guess Sector Surfer, I guess, is the message. But I didn't individually pick the countries. I went with pre-canned strategies. I didn't feel like I had the time to sit down and research a new set. But that would certainly be something worth doing.
Who canned the strategy?
Well, they're just the strategies that appear in the Hall of Fame.
Oh.
If you go to the Hall of Fame, click on ETF, look at the top ones, you'll find country ETFs, you'll find sector ETFs, you'll find asset class ETFs. Some of them, probably most of them, do not have forward walk progressive tuning on them. So that's something you got to do yourself. But there are a lot of good candidates out there. Well, basically, that's what I had. If there are any questions, any more questions? If not, I'll turn it back over to Joe and let him do a wrap on this.
Thank you very much, Glenn. Borrow your cable. The waitress comes back in, there's a lot of glasses, it looks like needs refilling before we get into the next part.
Thanks, Phil.
Yes, sir.
Sorry, Joe?
Are the slides gonna be available?
Yeah.
Okay.
Yeah.
We will.
They're PowerPoint slides.
Yeah.
So Joe, do you have bandwidth for a question?
I probably don't have the answer, but
Well,
sure, go ahead.
We'll take one thing at a time, one step at a time. Do you know if Scott is doing anything with some automated way to run through all the decision shift days so that you don't have to do, some factorial number of combinations manually?
No, I don't.
You don't know?
Be a good, no, I don't know.
Seems like a way, there should be, because there's 4 combinations of filtering and the other one, both off, one on, one off.
Yeah, oh, yeah.
4 times 22 or whatever number of combinations of that plus,
That would be-
It's monthly, weekly, and
yeah, and all those kind of things, so some
Well,
audit.
He might have to charge more.
It may be
because
over,
you're gonna chew up
well, it's
more
worth it, I mean,
bandwidth.
if you have more than a trivial portfolio,
Yeah.
Yeah.
so,
That'd
Although
be a
maybe
good
a
one
curve fit if you
to
do that.
submit,
yeah,
send an email.
yeah.
Yeah, good idea.
Just take a rest for a minute.
I mean, it makes it easier to curve fit, but on the other hand, I'd rather know than have to spend
People
time.
did it.
That's very, very
wrap
nice.
your head around the walk.
I got it now.
The forward walk, how is that different? Is that
The
something?
older the better, so that's
Well,
easier.
not all hip hop
Right.
is
Alright.
hip hop,
There's
maybe
a
they'll
really-
sing it.
Take a look at this paragraph there. It explains it better than I articulated.
Hi, Rod.
So I thought you were going to show your winning strategy.
Interesting. He's a winner.
What's on the website?
Yeah.
Yeah, it's on the website,
Yeah.
right?
3 plus 10 honorable mentions.
Right. It fails in comparison to your strategies at the stocks. You put stocks in.
Right, it just,
Katie Martin.
right, it's there.
That one.
The problem I fear is that it's sort of back tested. You know that Amazon and